last thing the stock market wants right now is a government shutdown. And here's why it matters so much for investors. September has been surprisingly strong for U.S. equities. Historically, this month tends to be tough for Wall Street. But so far, the S&P 500, Dow Jones, and NASDAQ have all managed to post solid gains. Investors were hoping to ride this momentum into the fourth quarter. But now there's a new roadblock: the growing likelihood of a government shutdown beginning October 1st. On the surface, a shutdown might sound like just another political standoff in Washington. But for markets, the real problem is data, or the lack of it. One of the most important economic reports of the entire month, the September jobs report, is scheduled to be released this Friday. If the government shuts down, that report won't come out on time. Why does that matter? Because the jobs report is a key measure of the economy's health. It gives investors insight into how many jobs were created, what unemployment looks like, and whether wages are rising. All of this plays directly into the Federal Reserve's decisions on interest rates. Without it, investors are left guessing, and markets hate uncertainty. It doesn't stop there. If the shutdown drags on, it could also delay the release of inflation data, like the Consumer Price Index, which was due on October 3rd and again on October 15th. Those numbers are just as critical because they help determine how aggressive the Fed might be in the months ahead. Without this data, traders and policymakers are flying blind. Now, this isn't the first time markets have faced a government shutdown. Back in 2013 and again in late 2018, we saw similar situations. Interestingly, stocks and bonds often recovered even before the shutdowns ended, as investors shifted focus back to other market drivers. But this time, analysts warn it could be worse. Why? Because more agencies are expected to be affected, meaning the data blackout could be more widespread and disruptive. Meanwhile, there are other factors weighing on the market. Valuations are already under scrutiny, with Federal Reserve Chair Jerome Powell recently noting that stocks are fairly highly valued. On top of that, the once red-hot AI sector is starting to cool, with investors taking profits from mega-cap tech stocks and moving into lagging areas like energy. This sector rotation shows that traders are becoming more cautious, even as indexes post gains. So where does this leave investors? In the short term, a shutdown could mean heightened volatility, delayed data, and uncertainty. But in the long term, many analysts believe the market will shake it off, just like in previous shutdowns. The fundamentals of the economy, corporate earnings, and the Fed's next moves will ultimately carry more weight. In other words, the biggest risk right now isn't a complete collapse, but rather confusion and short-term turbulence. For long-term investors, staying focused on the bigger picture may be the smartest move. Do you think a shutdown will spark a major sell-off, or just a temporary dip? Share your thoughts below, and don't forget to like and subscribe for more market updates.